how would you analyze and fund this deal? And it was a bath bomb manufacturer, and this is based off of a deal that we actually did. $925,000 in cash in the bank, $138,000 account receivable, a couple $100,000 in a note receivable. They had a certificate of deposit, which is kind of like a cash equivalent type thing, of $50K. In an E-Trade account, they had $120K of securities, stocks that is, and raw materials inventory of about $225K. Work in process, which is the things that are between raw materials that are kind of being turned into inventory but not yet finished, of $138K. $735 in inventory. Their manufacturing and furniture in the offices and stuff, $430K. A couple of vehicles totaling $120K. If you add all that up, it came to $3,082,500. And they were asking $3.2 million for the business, doing $333,000 a year. We calculated the multiple for you at 9.6. $6 million in sales, about 3.6 of that, just a little over half, is recurring revenue. They have short-term debts payable of $140,000 in accounts payable, and a patented extrusion process. They're only running one shift a day at about 37% capacity. And then they're getting their leads through podcasts and live events, selling through a sales rep network and AdWords. The CEO is leaving the company. That's the founder. COO and CFO are staying on. They've got about 869 customers that are active, plus 22,000 prospects in their pipeline. And the seller is leaving to start a new business. So the question was, how are you going to fund this deal with $0 out of pocket and also put some money in the bank? So there are lots of different things. And remember, there's no right or wrong answer here in terms of the types of things that you could do. You could do carve outs with cash. You could replace it with a letter of credit or something like that. You can ask the owner to carry parts of the accounts receivable so that they basically are keeping those. You could carve it out as a deal. You can have a third-party factor. You could get asset-based lending on those. And the same things that apply to accounts receivable apply to note receivable. You could also do a carve out or liquidate the securities in the the certificate of deposit. You could carve out or liquidate the securities in the E-Trade account. There's also a thing you can do when you've got stocks called a margin loan, that your broker will loan you a certain part of the money on those. Raw materials, we could send them back. We could return them, some or all of them. We could consign them to the on a consignment basis for the seller. We could actually ask the supplier if they would turn those into consignment for us. We could do asset-based lending. We could go and sell the amount that we had that was over what we needed. On our work in process, there are ABL, asset-based lending loans on that. The SBA in the United States, the Small Business Administration, also will make loans available. And we didn't cover all of these things. So I'm just giving you kind of a list of things you can do, and then I'll break down on the DealDone software how we would go about it. The inventory could be liquidated, some or all of that. You could get a line or letter of credit or a warehousing fund on that as well. That's just basically a line of credit. You could hold a sale to sell off as much of that inventory as possible to generate cash quickly. You could also do a seller consignment like Jeff did, which was great. You can do on the furniture, fixture, and equipment. I think he mentioned he did a sale leaseback. You could do a sale repurchase as well, meaning that you sell off everything that the seller has or carve it out, and then you go and repurchase it at a much better financed rate, or you lease it. You can do an asset-based lending on that. SBA is actually also has loans on that. And you could do the same things on the vehicles, except you could also do just a straight lease. So lots of different options there. And then in terms of these other things that are here, things that we want to consider are going to be an earnout, owner carry, carve outs, an earn in possibility, maybe doing some asset-based financing. A baseline deal would also be something that you could consider doing here. You could do revenue-based financing, a deferred down payment. I don't think that was one of the things that Jeff mentioned. And here is, I'm going to switch over to the software and show you how I would go about this. Okay, so this is the DealDone software. So basically, I have put in the amounts of the assets that we have in this deal, the software allows for other assets as well as third-party inventory, real estate, and manufacturing equipment, and additional assets that might not have a particular category. So we first say, what is our deal funding from the assets analysis? And here we just pick drop down. Am I going to keep it in the business? Not applicable. I'm going to keep it in the business, or it's a carve out. And we could elect to carve out here. This is keep in business. So I'm going to say no, which was a carve out. We could carve out half of it. There are little explanations here. You can see that say what each of the things are. But here I'm going to say of the 925,000, I'll carve out 425K. That'll leave me 500,000 available for funding, which if I wanted to, I could do that through a line of credit or something like that. I just said, and there's all kinds of choices obviously here that you can choose among in the software, which are just the things that I've already told you guys. And the net funding here, you can adjust up or down. I just said 50% financing on that. I might want to finance more of that. I could jump up, and of course it adjusts dynamically with everything you're doing. Maybe I could go to 70%. Then I hop back over here and I say on the accounts receivable, am I going to keep that in the business? What I like to do, by the way, when I am going through this analysis is the very first thing I want to do is figure out what's the maximum amount that I can get out of this. And Jeff did a great job of that. So I'm not concerned yet about can I afford it or anything like that. I just want to know what's the maximum amount of cash that might be available. So these accounts receivable, I could carve out, or I could keep them in the business and factor them. And what would the percentage be here? I'm just assuming that it's good credit on these people. So I'm factoring 85%, which is going to get me $117,000 over here. Then I hop back down to the note receivable. That I just carve out. I say, look, Mr. or Miss Seller, I'm going to let you hang on to that note for the 200,000. The CD of $50,000, I'm going to carve that out also. I'm just going to let the seller keep that because it's not something that we need in the business. Same thing with the securities, 120,000 in securities. I'm going to carve that out as well. And then we get to our raw materials. But before I look at that, I'm going to go, I've not got anything else I'm carving out, but you can see down here, I have total carve outs down here in the green of $795,000. So that's just adding up all of these things that I chose to carve out here. But then as I go down and look at the rest of the list, the raw materials, that's going to stay in the business. The work in process is going to stay in the business. The inventory is going to stay in the business. The FF&E stay in the business, and the vehicles, they're going to stay. So then we say, well, what do we do to turn those into money? And so the inventory, the raw materials, I'm going to return as much of that as I don't need. So I choose from this list return. I'll get 100% credit on that, or maybe maybe they charge a 5% restocking fee and I get 95%. But I'm going to assume that I can return that to a supplier and negotiate getting full value for that. And I'm going to move to a just-in-time inventory system to where I don't need this inventory of raw materials. I have them delivered to me as I put them into work in process. So there's never an investment in this inventory. One of the big things you can do to increase profitability of an inventory-based business or a manufacturer is to shift the cost of the inventory, the holding cost of the inventory, to either the supply side or the demand side. The supply side, you do it by having just-in-time inventory, also called JIT. And if you're thinking, well, I couldn't possibly have that if I had a real company doing business, I can tell you that the Toyota and Lexus manufacturing facility literally have no inventory of raw materials. They have trucks showing up every hour with the exact things that they need raw materials wise to assemble their cars so that they don't have to have that investment. One of the most brilliant inventory management systems that I have ever seen. So I'm gonna look at returning that. My work in process, I've got 138,750. So I'm gonna do an asset-based lending deal on that to get financing at about 50%. I might even be able to get 55. That's going to be 76,000. I'm going to go back here and look at my inventory. I had 735,000 of inventory. So if I do a seller consignment on that, I'll get 100% of that knocked off, and we'll be releasing that to the seller as we sell it. So that's 735K. Then I go over here to the FF&E. That I am going to go, I could finance it, or I could do a sale leaseback. If I did a sale leaseback, then if I assume I can get 50% on that, that'd be 215,000. I think either with the sale leaseback or getting financing on it, that's probably where I'd be at about 50%. And then on the vehicles, I've got 2 vehicles totaling 120,000. I'm going to do a sale leaseback on those. I probably won't get the full 120. It'll be whatever they're valued at now. Let's say they're valued at, that their market value is 75% of what we paid. So that'll get me 90,000. So then I'll go over here and say in my net to funding column, this is going to add up all of these items. And you can see it's 1,809,250,000. And so I've got 795,000 in carve-outs over here. And then I've got asset funding of 1.8 million in excess of that. Then I go down and look at my sheet and I say they're asking 3.2 million for the company. Sales are 6 million, EBITDA SDE at 333. So the multiple that they're asking is 9.61, and the industry multiple is 7.94. Now I'm going to hop back here and say that when we start our analysis, here on the industry to see what's fair. And Jeff did a great job. We're going to go through both of these and say, what are the revenue multiples that might apply, and what are the EBITDA multiples that might apply? The very first one would be potentially, this is a bath bomb. It's kind of a household product. And we see that the revenue multiple there that would apply would be 3.13. It might also be specialty retail or online retail. Online, interestingly, is worth a full 2 times more than a specialty line at a brick and mortar retail. So that's kind of interesting to know. So it might fit any of those categories. And then when I go to the EBITDA multiples list, I see that it could be household products, which are selling at a 14.76 multiple, or it might be miscellaneous specialty retail, 794, which is the one that I think Jeff picked. It also could be personal products, which come in at 17.73. So then we say, is the asking price reasonable? And here's the analysis that we do. We say, okay, is a 9.6 SDE multiple reasonable? Well, our benchmark for across all industries, we know as a multiple of EBITDA is 3.7 for professionally managed companies. The asking price here as a multiple of revenue is 0.53. And you can see down here in the little flashing area, I have told you how I calculated that, the 3.2 million asking price divided by the 6 million in sales. So, and in terms of a multiple of revenue, they're asking 0.53. In terms of a multiple of EBITDA, they're asking 9.6. Then we take the things that we found to compare. We said the household products multiple on revenue was 3.13, retail online was 2.99, and retail specialty was 0.99. And then over on the EBITDA side, we saw that household products EBITDA multiple at 14.76, specialty retailers at 7.94, and personal products at 17.73. So if I look at this, it looks like that we have a pretty good multiple in terms of revenue. And then when we look at the EBITDA, we're way above just the benchmark average, but we do seem to be within the range of reasonableness on these other multiples. So as Jeff did, I'm going to offer them based on 7.94 because that's the lowest of the things that I've got here. So in this case, we compare our multiple of 9.6 to 7.94, and I'm going to look at 7.94 as the multiple I'm going to argue for. So now I go back to the software, having done that analysis, and I say, the multiple that I'm going to put in here, I've put in the ask price, the sales price of 6 million, the EBITDA, the SDE of of 333. It calculates that the multiple is 9.61. I'm going to insert this industry multiple here, the lowest of them. And you can see that they're asking 1.67 times more for this company than the lowest industry multiple. So what that's going to do is cause me to adjust a purchase price, which I'll show you in a minute. So then I'm going to go through and say, I didn't give you customer acquisition cost or average order value, but I'm going to assume that the seller will finance, as Jeff did. I'm going to argue for 80%. If I can get that, that's $2,560,000. And then I'm going to go over here and say, is there any value to any of these intellectual property assets? And it does exist. There's a patent, I told you. I don't know what the value is without getting an appraisal, but I do know that it's going to be at least $10,000 to get this patent in the first place. So I'm going to say that I could potentially argue for giving a royalty-free license. I could sell the patent, I could do fractional acquisition or a carve out or sell leaseback or a number of things. But if I just give tell the seller to give me a royalty-free license in the company, and then I'm going to knock 10,000 off of the purchase price by doing that. Then I'm going to look, there's some recurring revenue we talked about. Will the seller do an earnout? So I'm going to say, yes, the seller will do an earnout here. Yes. Will he do an earnout? It's based on a percentage, and I'm going to argue for a 20% earnout. So the software calculates that to be 640,000. So that's what I'm looking at for earnout. You'll see how all this stacks up in a minute. As to the people, we know that the founder is gone. The CEO is gone. The CEO is leaving. So I chose leave here. But I do, and as Jeff mentioned, I would offer integrator equity. So here I'm going to have my COO, MD manager, and my CFO finance person have the ability to have integrator equity. So I'm going to assume I can do something with those folks. The marketing methods, I filled that in here. There's all different kinds of things that you could choose, just so you know, but that's not really going to affect what we're doing here right now. And we have, I didn't talk about financial statements, but it's nice to know whether those exist or not. We put in the number of customers and leads. And then we came over here to the bottom and we see that we've got in debt accounts payable of 140,000. What can I do? I'll probably just take that subject to, as opposed to doing a formal assumption. I won't make the seller pay it off because then it wouldn't be available to reduce the purchase price. If I take it subject to, then I'm going to get credit for that 140,000. So that's another 140,000 that comes to the deal. And then over here, we said, is there audited financials? You didn't have that information, but what will they do with the money? WWT, DWTM. Here, we don't know what they're going to do. We just know that they're planning on retiring, right? They're planning on leaving the business, retiring. So this says all the reasons that they might leave. But I didn't give you what they would do with the money, and I didn't tell you what the seller ultimately wanted. You're going to want to ask those questions. Now, when we go to what does this look like in terms of deal stack, we say, okay, here are pre-LOI things that we want to think about. The seller's asking 3.2 million. The ask multiple was at 9.61, but the industry multiple is 7.94, means that we like the idea of using the industry multiple, and Jeff did this, and it's 2644020. Is the ask higher than fair market value? The ask is higher than fair market value, so the software will automatically pick the lower of ask or fair market value, and so your suggested maximum offer for this deal is 2644020. We don't have any discount on top of that we're saying we're going to negotiate here, but knowing this column is here, that means that is something that you might consider doing. The net valuation here then is 2644020. We are acquiring 100% of the equity. We could acquire less. We could say we're only going to acquire 80% of the equity, and then that would change the number. So if we found we couldn't afford it at 100%, the software will allow you to acquire less, and then it'll tell you what the net purchase price after all that is. Then we go and we say, well, what's the valuation going to be for these integrator investors? And Jeff did a good job of this too. I'm going to make it the greater of ask or fair market value. So it's going to be based on the seller's ask of 9.61. These are people that are working at the company. They know what the seller's ask is. There's no alternative valuation here. So our valuation for investors is going to be 3.2 million. If we then use a PPM for equity investors and sell 20% to those based on a $3.2 million valuation, that'd be 640,000 cash that's coming from the investors. And then I go back up here and say, what about integrator equity? Well, remember, I'm going to sell 10% to these two key people, the COO and the CFO. So I put that here, and it will calculate that that total is 20%, which would be multiplied by the 3.2 valuation, 640K. So how does all this stack up? Well, we know our purchase price here in this model would be 2644020. Our integrator investments are 640K. Our investor investments are 640K. And our seller financing based on the 2644 price has automatically been calculated for us at 80% at 2115216. The earnout of 20% would be 528K. The debt assumptions are 140K. That was our notes payable. All this is imported from other parts of the document, by the way. Less the carve outs that we did way early on of 795 means that the cash that we need for closing is negative 2.215 million. So 2.215 million that we do not need. So that means that we could actually put cash in our pockets. But then we go a little bit further and say, what does the post-closing deal stack look like? That was the pre-closing deal stack that we were doing here. After we close, we can do things with the assets. And so we had a 1.8 million in asset funding that was available. We had 10,000 coming from the IP, and that means a total asset funding of 1.819250. We add that to the pre-closing cash of 2.215, and we could, if we really wanted to stretch it, put about $4 million in our pockets and own the business. So now that's maxing out, like saying, what's the max that I could get in terms of cash? So now the next thing that we would do is we might go back and say, well, if we did that, we would really be stressing the company. And this is really the great thing about the software, is because now we can go back and say, I know I can do this deal, and I can do this deal and put 4 million in my pocket, but I really only need about $500,000 out of this. So then I can go back and say, well, what can I do? Maybe I don't want to go through the hassle of having investors. So I change that to 0. You can see now I'm 3.4 million roughly ahead. And maybe I only want to give 5% to each of these manager people. So I change that to 5. That means I'm down to 320. Now I'm down to 3 million excess. And so I just keep going back through all of these things and say, you know, maybe I don't want to do any funding on cash. I want to keep that $500,000, and I don't want to do anything on that. So I just make that 0. And that goes away. And maybe I don't want to factor my accounts receivable. I just want to hang on to those. So that's going to be 0. And what else do we have? Inventory, the raw materials. I don't want to return any of those. Instead, what I'll do is maybe I will liquidate part of that I don't need. And maybe that's 20%, let's say, right? That I'm going to liquidate. So I'll just do that, and it'll adjust that for me. And let's say on the work in process that I don't want to do anything there at all. So that's going to be 0. And then on my inventory, the seller won't consign it. So I go and get an inventory loan of 50%. And just looking at how can I make this look way better. My FF&E, instead of doing the financing on that, I don't do anything. I keep that. And then the vehicles, let's see, on the vehicles, don't want to do anything with that. I'm not going to do anything with the vehicles either. Okay. And then let's see what that does. So let's go down to the bottom, and now we see we're still ahead, 1,677,500, but now it's a way stronger company after this. And we haven't given away the 20% to equity investors, and we've only given 10% away to our integrators for money, that got us 320, which would be great for getting a down payment on the deal, right? So we own 90% of the company, and we put $1,677,000 in our pockets. So let's go and see if we can make it any worse to get us down to that 500K. Well, we could say that the seller is only willing to finance 50%. Now that's going to be a big change. So let's see how that affects our number. Well, we're still ahead, 884. Okay, we're getting closer to that 500,000 that I said was kind of my goal. And the seller now only has to carry back 50%. And let's say that the seller does a 10% earnout instead of 20. Now I'm 619 ahead, so I'm getting really close. And let's see, let's say I don't do anything with this patent. It exists, but I'm going to say I'm not going to do anything with that. So that's going to be 0. And what else do I want to play with here? Let's see. Let's say that on this, that's kind of, I think that's actually a pretty strong deal at this point. And you can see that it still allows me to put $600,000 in my pocket. So the value to me, like the really cool thing about the software is you get to go through and look at all the assets and all the options that you've got. And then you get to say, okay, how can I make this stronger? Now, I'll tell you what's cool too, that's coming in about 90 days is in the new version of this software is that we're going to actually put in the carry so that you'll see that if you're doing financing at 10% of inventory at a rate of 10% on a $500,000 of inventory, that's, roughly 400, I think it's $4,166 a month. And so it'll tell you what your payments are on each of these things as well. So you can determine what's the profitability, what are the expenses of acquiring the deal to fund and support whatever you're doing to make the deal happen. And then what's the gap? Is the gap positive or negative, which will help you figure out as well going forward, how does the financing on these things work? But as you can see, you could have put up to $4 million, a little over $4 million in your pocket on this deal just by going through and taking a look at all of the different things that you've learned so far. And keep in mind, for those of you who've decided to make the investment to go into the accelerator and elite programs, there's 200 and some more of these strategies. So it's very, very exciting what you can find.